Hello friends. So today we are discussing valuation under the Income Tax Act, under the Company Act. So this block is play as an interplay of section. So how, as per the old Income Tax Act dealing with this, and as per the new Income Tax Bill 2025 dealing with this. Suppose you are going to issue a equity share, then for the purpose of issuing equity share, you required to get it valuation from the IBBI registered valuer. That is as per the company Act. But for the purpose of income tax, your you can get a CA valuation certificate can suffix your purpose, provided your valuation is based on net asset basis. But in case you are going to value for DCM only, then merchant banker certificate is required. So as per the Company Act, always you required IBBI registered valuer certificate. But for Income Tax Act NAV basis, Rule 11 UA is prescribed by the Income Tax Rule to 1962. So only CA is authorized to do a valuation on the basis of net asset basis. But if you are doing valuation based on DCF, discounted cash flow basis, then merchant banker certificate is required. So I am taking a practical example. Suppose fair market value of equity share is 100, but you are issuing at 200. So 100 rupees excess part of security premium will be taxed in the head of company. Same way, you are a buyer, you are buying equity share of a particular A Limited from Mr. A, another shareholder. But the fair market value is 100. You are buying 50. So there is a provision under the Income Tax Act. This 50 notional income will be taxed in the head of buyer. But what about the seller? So there is a provision under section 50 CA as per the old act. The seller has to pay capital gain on 100 of what is the fair market value. Suppose you are dealing with a company having a real estate business. So there is a stock in trade land. So for the purpose of uh, business income, the land fair market value has to be taken as per the section 43C. So my dear friends, I have summarized these provisions as per the old act as well as new act. This 56(2) subsection 10 is only section is changed. New section is 92, but content is remain same. For security premium, excess part is tax under section 56 to 7B. This, as per the new Income Tax Bill 2025, we don't find this same provision. Might be the intention of the legislature is behind that they don't want to tax security premium in the hand of company. Same way, section 50 CA, 43 CA is also be filed as per the new bill. But more important is that 10% relaxation is given in section 53(1) because since you are a real estate, you having a land as stock in trade. You want to sell, but as per the present section 50C, there is a relaxation of 10%. But that is not found in section 43CA. So we same found the 10% relaxation in section new 53C. So what about the merger? So my dear friends, buyer seller both tax on national income basis under the head of income tax, income from other sources. Suppose you are going for merger. In that scenario, when merger is take place, there will be no transfer, not regarded as transfer in the end of shareholder, as well as the amalgamating company as well. but the same transfer is not regarded as transfer in the hand of the shareholder as well, provided certain condition is satisfied. So same provision is also in the new bill. So what is the tax rate for capital gain? After 23rd July 2024, there is a no indexation benefit given to the resident as well as the non-resident. So suppose you bought your share 100, now you are selling 1000. So 900 long-term capital gain is taxed at 12.5% as per section 112. In case of listed share, the section is 112A capital. So I am also discussing here is buyback. As per the present regime, PDT is gone away. Section 115 QA is redundant now. Even there is no provision as per the new bill 2025. So there is no BDT. If company is going for buyback, thus whatever the buyback price multiplied by the number of share the shareholder is company purchase their own share, that is taxed as income from other sources as deemed income as per section 222 clause F. That is a deemed dividend. But what about the capital gain working? So as per the recent Finance Bill Act 2024, there will be sale consideration taken as nil because as per amendment in section 46A, the same provision as per the new bill 69(1). So my dear friends, this is the scheme of taxation for equity shares between buyer and seller, issuer and shareholder, and taxability in the head of real estate. What about in case of stock transfer? So, my dear friends, in case of merger, there is a fast track merger as well as merger through the NCLT. Honorable National Law Company Law Tribunal is pass a order based on this merger scheme that uh, company merged with new company, amalgamating company become the amalgamated company. So there is a swap ratio. You get 1:5 or whatever the swap ratio company will decide and approved by the NCLT. So in case of merger, there is a chance for some valuation. Uh, so how this valuation take place? So as per rule 11 UA 1C of Income Tax Rules 1962, the formula is A plus B plus C minus L liability. So that is net worth multiplied by paid up value upon paid up full value. So more or less you have to get it this CA certificate from the for the purpose of section 56(2), and the same is for the purpose of 50 CA. So this is the comparative chart. In this chart, in case of issuer, you required valuation from merchant banker if this is based on DCF. Otherwise, on intrinsic value, CA certificate can serve its purpose. But for the purpose of companies, you have to get it from IBBI registered value. Suppose you issue a share more than the fair market value, then excess part of security premium will be taxed in the hand of company. Same way, if you are purchasing excess share, the excess income, notional income will be taxed in the head of buyer, as well as capital gain will be taxed for fair market value purpose for the purpose of seller perspective. So we have to do this transaction on fair market value purpose only. So I am taking this example for the purpose of merger. Suppose you what 100 share of Y Limited, your upon the merger, you got Z Limited share in order to surrender of 100 share of Y Limited. So now you are selling this Z Limited 100 number of share for rupees 5,000. So your cost of acquisition in respect of buy limited is 1,000. So 4,000 is long-term capital gain. 12.5% without indexation is your tax liability. So in case of buyback, as I said, my dear friends, whatever buyback price you get it, it will be taxed at deemed dividend section 2 subsection 22 clause F. So this deemed dividend, the company will deduct dividend, and there is no concept for buyback dividend tax. So after coming this amendment in Finance Act 2025 4, PDT concept has been gone away. So company has only to deduct TDS on buyback price because it is taxed as deemed dividend in the hand of shareholder. The simultaneously exemption under section 10 subsection 34A has been withdrawn by the same finance act. So in my example, you bought 100 share in 2020 year, your cost of acquisition is 4,000. So your bought price is 40. Now, after this BDT amendment, you are eligible for 20 share buyback. So this 20 share, your buyback price is 60. Your deemed dividend is 1,200 will be taxed in the hand of shareholder. Simultaneously, for the purpose of capital gain working, your 40 multiplied by 20 share is your capital loss because as per section 46A, your sale consideration will be taken as nil. Your cost of acquisition will become the capital loss as long-term capital loss or short-term capital loss whatsoever. So this is the buyback scenario. So my dear friends, what are the general tax planning the company do in case of merger or buyback? One of the most significant challenge in both merger and buyback. Company may manipulate valuation to influence the terms of transaction as per their own wisdom. The timing of merger or buyback close to the end of the financial year can be used to defer tax liability. Company amalgamate merger, many companies by the fast track merger or NCLT route whatsoever, they are fairly flexible. So in order to get it, some losses in other company S limited can go into H limited. Same way, other kind of merger scheme can be approved by the NCLT. So this type of tax planning they used to do. So valuation play a crucial role in ensuring compliances with tax provision, facilitating fair transaction in merger acquisition and buyback. Whether dealing in real estate, stock, share repurchase. So whatever the your share purchase agreement is there. So based on that, the transaction took place. So understanding valuation guidelines set forth by the Income Tax Act as per the Company Act is vital, play this vital role in order to accurate calculate capital gain tax and reporting in the head of shareholder head. So chartered accountant certificate, IBBI registered valuer certificate is a play important role for the purpose of valuation of shares. So they give fair market value as per the Income Tax Act and as per the company. But in case of DCF, merchant banker is only authorized for the purpose of income tax. So stay this hope so you like this video. I summarize the valuation important concept in this important through this PPT. Definitely I will share this PPT in the same video so that you can easily understand what is the purpose of this valuation approach. So I have also touched upon some practical insight in case of transfer share by resident to resident. Mr. I is transferring their share to Mr. I2 should not be below fair market value. Valuation is required as on the date of transfer. my dear friends, not as per the latest audited balance sheet, as per the date of transfer. So, in case of further issue of share, company to resident should not be below fair market value because the same will be taxed in the head of company, excess part of security premium. So, valuation is required from the IBBI registered valuer for the purpose of section 62(1)(c). So, my dear friends, you also required in case of merger to determine the swap ratio between all uh, companies as specified in the merger scheme for the purpose of compromise and arrangement, whether it is fast track or whether it is through the NCLT route, the same is required from the IBBI registered value. So, in case you are going for buyback, you also required IBBI registered valuation certificate, that is a valuation report to determine basis for valuation. That is also specified in the buyback rules. So practically, we deal with section 56, 210, 50 CA. In case of non-resident, FEMA guidelines is also there. So we should not make a transfer to NRI below the fair market value or above the fair market value as the FEMA pricing guidelines is defined. In case transfer took place between the non-resident and company and non-resident to non-resident or resident to non-resident, non-resident to resident, then it is a responsibility of a resident or non-resident to deduct tax deducted at source under section 195 as a withholding tax as per the Indian Income Tax Act 1960. So whatever the capital gain that is liable to tax in the head of non-resident, you should deduct TDS upfront. So in case of ESOPs, you are also required to get it valuation from the IBBI registered valuer for the purpose of Ind AS 102. In case of grant of ESOP for the purpose of compliance, Ind AS 109 fair value need to be valued by the RB for the purpose of. So my dear friends, this is the main theory, main summarized way for valuation under the Income Tax Act, under the Company Act. Hope so you like this video and this is most educational purpose. Many, my dear friends, is confused who is the authorized and when at what time we require valuation. Thank you.